Good afternoon. Welcome to Halftime Report. I'm Sonia Shenoy and with me is Mangalam Malu. Well, things are looking good actually. Just pull up the intraday chart of the Nifty. It has now moved into the green. Of course, I mean, it could have gotten worse, but it didn't. And, you know, the US markets are very volatile. There's a big jobs data that's coming out later in the evening. The US markets are shut on Monday, so there could be some amount of uncertainty. Given all of that, this market is resilient, holding on to that 17,500 mark, not giving up on the 20 DMA. So I'd say all is not lost.
All is not lost. And, you know, it's like a Friday afternoon, the market. Everyone's waiting for the weekend, and it seems like the Nifty Sensex as well as the Nifty Bank, as we speak, you know, all three indices are absolutely flat as compared to yesterday's close. So even if you got up late on the Friday morning, you perhaps missed nothing, or maybe you did miss a lot of action, which accounts for nothing right now as far as the price movement is concerned. But the interesting thing is that the mid-caps are outperforming, and they usually outperform when the street believes that, you know, there is strong support for the large caps themselves. But, you know, really it is a market which hasn't yet made up its mind after a big move that we saw in the last couple of trading sessions. Big moves on either side, so to say. So absolutely flat right now. Let's see where the second half trade takes us. Importantly, let's talk about a couple of sectors now. Shipping is in focus. GE Shipping is a stock on our radar first up. And the key question to them is whether the global slowdown is impacting their earnings or not. What's the impact on dry bulk business? And have we looked at rates normalizing in the post-war situation? We have G. Shivkumar, who's the Executive Director and CFO at the company, joining us on the show. Thanks a lot, Mr. Shivkumar. Always a pleasure speaking with you. And that really is the first question, you know, because the last time we spoke to you, you said that rates had seen an abnormal rise, and that was because of the Russia-Ukraine war. Post that, a lot of things are coming to terms with this situation, and rates are reflecting that as well. Have we seen some sort of normalization of those rates? How is the international situation like right now?
Yeah, so tanker rates are, first of all, thank you, Mangalam, for having me. Tanker rates are very strong still. In fact, crude tanker rates have become stronger in the last month or so. Again, mainly driven by the war. It's also now the crude tanker, some of the drivers of the crude tanker rates are pretty high exports out of the US. You know, they've released the crude from the SPRs, and that's long ton-mile demand. So, and therefore, crude tankers are doing very well for the last month and a half. The larger crude tankers, the smaller crude tankers were doing well for the last since April, May, and now you've got the larger ships. The VLCCs also joining in the party. On the dry bulk side, the demand pressures are showing. The trade is actually down probably 1 to 2% this year. We had the market kept up by congestion and that was, you know, tying up ships, basically COVID-related disruptions. We have seen congestion dropping by 5% in the last month and a half, and as a result of which the big ships have dropped a lot. So Capesize bulk carriers have dropped now. The spot index is now at about $3,000 a day versus you know, the high in the last 12 months was, I think, $80,000 a day in October last year. And it probably was 30,000 less than 2 months, about 2 months ago.
So you're saying the spot prices have fallen from 80,000 to 3,000?
Yeah, 80,000 was the peak in October last year.
Okay.
It was about 30,000 in end of June for Capesizes. Now these are the big size ships, which are really affected by steel and coal demand. The smaller ships are a little less affected. Of course, they've dropped as well. 30,000 has become about between 12 and 20,000. But the dry bulk market is feeling the effect of poor demand.
That's quite a steep fall that we've seen. So what does this mean for your own business? I mean, if the dry bulk market continues to be under pressure, you in any case have barely seen a 5% revenue growth in the quarter gone by. You think there could be a degrowth in the subsequent quarters?
No, I think not to, again, make forward statements, but I think the crude tanker rates have and the product tanker strength, which has continued. And remember that we got product tanker strength for 2 months of the last quarter. Currently, we've had product tanker strength through the quarter, and rates which are fixed up to now will take us through to end of September. So I think the tanker rates compensate for the dry bulk drop.
Right.
So,
What we're trying to get at is that what does it mean for GE Shipping's business? I mean, in FY22, you did revenues of almost 3,500 crores. That time you had said that for your FY23, you had about 750 crores of revenue visibility for shipping and almost 670 crores or 700 crores coming in for offshore as well. Put both of them together, that is around 1,500 crores. So that's half your annual revenue, which was for sure. Now, now as we speak towards the end of the first half of this year, where does your outlook for this year stand?
So again, no forward-looking statements. We don't know how the market's going to play out. And this is a very uncertain market. As you mentioned, demand is actually lower on the products, on the oil consumption side. It's not yet come back even to 2019 levels, pre-COVID levels. Despite that, rates are really strong because of these disruptions which are going on. And, these disruptions can really unwind, not easily, but they could unwind anytime. So it's tough to make a call for this. All we can say is that, the first 6 months of this year for tankers are much, much stronger than the first 6 months of last year. And I'm talking of 2 to 3x in terms of rates. We were earning $10,000 a day on average in the first half of last financial year. This year, it's well in excess of 20,000, probably in excess of 25,000 on average.
Okay. Any investment plans that you have in your shipping business?
We'd like to invest. Unfortunately, because the market is so hot, asset prices are really high. We are value investors, and we are patient capital. We'll wait for the right opportunity at the right prices. We've sold a couple of older ships, and so we've released cash. We are now very low net debt. So we are waiting for opportunities. Unfortunately, none so far.
That's typical of GE Shipping, right? You'll wait out, and when the going is extremely tough for everyone else, you'll go ahead and lap up a lot of assets at low prices. Interesting that you have sold a couple of old ships as well. If you could tell us the kind of cash that you've raised from that. And, the other thing is that we're looking at your crude prices, as in currently, as we speak, crude prices are around that $93, $94 per barrel mark. We also wanted to understand, how does that impact your business on a net basis? Because on the one hand, bunker fuel prices, are impacted. So that is a cost item. And on the other, you have demand for crude liners increasing or decreasing depending on the way crude prices move. So that was something that I wanted to understand.
Yeah, so the bunker cost is typically a pass-through. It's priced into the market. And if the market is strong, the customer takes that. If the shipping market is strong, the customer takes that cost increase. If the market is weak, the ship owner takes the impact. It helps the offshore business that oil prices are high. And one thing which has happened recently is that when the Brent WTI spread went high, it meant that there was more demand for exports of US crude, and that helped to boost VLCC demand and therefore VLCC rates. So it's not so much the price as the supply of crude. If there's a lot of crude being supplied, it's good for our business, because if it is supplied, it will go onto a ship. And if it goes onto a ship, that means more demand for ships. So the worry about the high price of oil is if there is a demand recession for oil itself, which means lower demand for ships.
Right. And you said that.
On the flip side, drawdown of inventories in the last 6 to 12 months is a really positive factor, because I think crude inventory, especially in the US, have dropped to very low levels.
Right. And what was the cash you said you raised from selling these ships? And as a result of that, what's the debt on your books now?
It's less than 50 million, not a huge amount. Okay. We are sitting on $400+ million. This is less than 50 million, but on the margin, it helps.
Okay.
Okay. All right. Mr. Shivakumar, we'll leave it at that. Thanks a lot for joining in and giving us an update on the business. That's GE Shipping for you. For the market itself, it's still not too bad, really. I mean, it's absolutely quiet, but all three indices have now moved into the green. The Midcap index is up about 100 odd points. Let's slip into a quick break. On the other side, I'll give you an interesting analysis of the August auto sales numbers and the big trends that we've identified in this space.
Welcome back. You're watching us here on Halftime Report. As we speak, just keep an eye out on Adani Ports. That's the stock which has now moved to the high point of trade, doing extremely well this afternoon because they had released their operational data for August as well, where there was an 18% increase in the volumes, the cargo that they handled, of which 44% growth came in from dry bulk and 8% growth is what the company saw in its containers division. So doing well for them. In fact, this year itself, they've done, nearly 11% jump in their overall cargo handled at their ports. That stock doing well. But let's move on to the big story today. Auto sales for August were a mixed bag. Sonia Shenoy has now moved on to the big wall with an interesting analysis of the trends that really stood out last month. What was India driving, Sonia?
Well, the auto sales for August are out, as you said, and there are some really interesting trends that I've observed. Now, the first big trend I noticed is that commercial vehicle sector growth rate has slowed down sharply compared to what we've seen in the previous months. Now, this could be due to the base effect wearing off. It could also be because of the monsoons, but growth has slowed down to low single digits. Take a look at all the three commercial vehicle players. Tata Motors has barely seen a 6% year-on-year growth this time, in CV sales, that is, while Eicher Motors has not even made it to 5% growth, and Leyland saw a 51% year-on-year growth, but that is on the back of a lower base. Now, the next big trend that I noticed is that there is a sharp fall in two-wheeler exports in August. Bajaj Auto saw a 28% year-on-year fall in exports because of Nigeria restricting two-wheeler movement. Remember, Nigeria retails were down 25 to 30% for Bajaj Auto, and Bajaj Auto gets 20% of their export volumes from Nigeria. But Bajaj is not alone. It was down 28%, while Hero MotoCorp saw a 48% fall and TVS Motors saw a 15% year-on-year fall. The third and final trend that I noticed is cracker demand for the passenger vehicle sector. Could be because of new launches, the supply side situation easing, and a robust order backlog which aided the passenger vehicle space. So let's take a look at the numbers. Look at this. Maruti's domestic passenger vehicle sales were up 30% year-on-year. The pick of the pack really was M&M on the back of a solid 87% year-on-year growth in sales, while Tata Motors was not too far behind. Passenger vehicle sales rose 68% year-on-year, and it's seen a big jump in electric vehicle sales. They were pretty electrifying at 276% year-on-year growth, coming in at 3,845 units, purely because of the sale of the Tata Nexon. So those were the big trends that we identified in the month of August.
All right, Sonia, thanks a lot for that. Those were the big trends in the month of August from the auto space. In fact, we also heard from the management of Eicher Motors, Bajaj Auto. Let's hear out what they had to say of the way August went and, more importantly, the outlook for the way ahead.
The month of August, there is also impact of monsoons. So I think it's that. Otherwise, CV industry per se is doing very well. And we are expecting good growth overall for the year. If you look at first 5 months, we have sold 28,500, and which is 91% growth over previous year's first 5 months. And if you look at the industry has grown by 88%. So we are doing better than the industry. If you look at the overall industry sales, I think this year, in balance 7 months, if we project based on the last year's 7 months, and if you add some nominal growth in that, I think we will be quite close to the earlier peaks of 18-19. This year, first 5 months, we are at 25%. So we are consistently gaining in the bus segment.
Decline in numbers which you're seeing in export sales is not really the outcome of Egypt. If you may recall, we had said that there are developments in Nigeria and a few other parts of Africa, but particularly Nigeria, where retails have slid downwards for two reasons. One is, of course, there is inflation and lower availability of dollars, but there is also an uncertainty due to certain pronouncements by the government of India, government of Nigeria, restricting the movement of motorcycles. The Nigerian retails have shrunk by 25 to 30% for us. And what happens in that is that we like to take a prudent view because it's a long supply chain. And if these retails continue at this level, we don't want overexposure of our distribution partners in terms of stocks. So this month has almost been a nil month of exports to Nigeria so that we take the hit and get the process of getting the stocks in balance. So it's really that one issue. And of course, the Egypt issue, which is a much smaller one when it comes from when you look at it from a number point of view.
All right, that's the word coming in from Motown experts out there and company owners. But just keep an eye out on, Adani Enterprises. Remember, it enters the Nifty with effect from September 30th. The stock has done extremely well, 95% higher this year itself. Before the announcement came by, the stock was up by almost 89%, and now it's surging. It's moved to the high point of trade. On the contrary, just keep an eye out on Shree Cement. That too is struggling among the top Nifty losers, actually right now down with a cut of almost 2%. So this was something that was expected on account of the announcement, and as a result of which we're seeing the moves as well. There was a Edelweiss quant note which was saying that almost $300 million worth inflows are expected in Adani Enterprises as a result of this rejig, and nearly $100 million of outflows from Shree Cement. This, remember, is with effect from September 30th. So, the changes will come in from the close of September 29th. So we'll just keep an eye out on that. While Adani Ent is moving, all the other Adani Group stocks also at the high point of trade. But it's a quick reminder for our viewers, it's that time of the year again where Money Control Pro's financial freedom offer is back, and this time with added benefits. You can get a Money Control Pro subscription at net zero cost by claiming exciting offers worth 1,500 rupees from our partner brands. Grab the benefits now only on the Money Control app or website.
Welcome back to Halftime Report on CNBC TV18. Well, just wanted to point out that some of these tractor makers have been doing quite well, and we'll tell you about that in detail in a bit. But most of them, whether it's Escorts, M&M, have all been hitting record highs. That's because 52-week highs. That's also because in the month of August, finally, there's some growth in the tractor segment compared to a double-digit decline that we've seen in the preceding months. So we'll talk about that in a bit. In the meantime, Adani Enterprises gains while Shree Cement slips after NSE announces that a Nifty 50 rejig will see the former replace the latter in benchmark index from the 30th of September. Mangalam, take it away.
Yes, we were just talking about the way Adani Enterprises has surged right now. So let's put things into context. It will be included in the Nifty from effective 30th of September. And making way for Adani Enterprises will be Shree Cement, which will be excluded as well. The changes are in line with what the street was working with. Brokerages were expecting this to happen, and a large part of that was because of the price as well. In fact, in this year itself, before today's move, we saw a 90% up move on Adani Enterprises, whereas Shree Cement was down 21%. Add that to today's move, 95% is the jump that we're seeing on Adani Enterprises, and nearly 25% is the decline that we're seeing on Shree Cement as well. What does this mean? All the passive funds which track the Nifty will have to, rejig their portfolios as of September 29th close. And what would that mean? That they would have to sell Shree Cement and add Adani Enterprises. In terms of flows, it would mean almost $300 million worth inflows coming in from for Adani Enterprises, whereas Shree Cement would see outflows of almost $95 million. Adani Enterprises will of course be the second Adani Group stock to be on the Nifty after Adani Ports, whereas with Shree Cement's exclusion, now the only standing cement stock in the Nifty would be Ultratech. Of course, Grasim is part of Nifty as well, but that is primarily holding Ultratech shares, so as a result of which that qualifies as a cement company. But a pure play cement play on the Nifty would then be only Ultratech. So that's the way the Nifty is moved.
Okay, well, let's move on then. Sources tell CNBC TV18 that a number of bids have been received for the minority stake in NTPC's green energy arm. Abhimanyu is here to tell us more. Abhimanyu, over to you.
where ArcelorMittal, Brookfield, Canadian Pension Fund, NIF are among the bidders as far as the 13 bids are concerned for NTPC's green energy stake sale. It remains to be seen how these bids will be considered and what will be the amount of stake which will be divested as NTPC Green Energy remains open to raising up to rupees 2,000 crores as equity and remains open to stake sale between 5% to 26%. Also, NTPC is looking forward for listing of various of its subsidiaries, be it NIPCO or NVVN. Also, NTPC is looking at the possibility of selling off its non-core assets, particularly in the fertilizer domain. NTPC, what sources have indicated that NTPC is not going to launch any greenfield coal thermal power plant. However, it's also not going to close down any thermal power plant more than 200 megawatt capacity. It remains to be seen what is going to be the status of the bids for NTPC Green Energy, since the subsidiary of NTPC is looking forward to raise money as part of this exercise.
All right, we take that point. The other stock in focus is BEL, and why is that stock buzzing? Bahishta joins in with more details on that. Bahishta.
Well, Citi had released a report on Bharat Electronics wherein they have a buy rating on the stock, and the target price has been raised to 356 rupees from 342 rupees earlier. The company continues to benefit from strong structural tailwinds in defense manufacturing. The FY23 prospects also continue to remain healthy. The company has reiterated that 15% revenue growth could be achieved and 21 to 23% is the margin target for this year. The medium-term outlook also remains robust for the company. The company has said that they continue to see healthy order win opportunities in the industry, and they are expanding footprints in allied non-defense areas and defense exports. Citi has said that the stock is at reasonable valuations at the current levels.
Okay, thanks a lot for that. Well, there's a lot of action in the small caps as well. Sonal is tracking a host of them for us. Sonal, what do you have?
Well, 3 stocks on my radar, Sonia. Let me start with Dodla Dairy. Well, there is a big transaction that has taken place. TPG Dodla Dairy Holdings sold 58.3 lakh shares or 9.8% stake in the company, and now they sold basically for TPG Dodla Dairy Holdings sold around 40 lakh shares and raised around 203 crore rupees. Some other funds, something like Ashoka India Equity Investment Fund, Plutus Wealth Management, and Steinberg India Emerging Opportunities Fund bought the stock. Confidence Petroleum in focus. The stock is up around 8-9% today. There's a board meet on 6th of September for preferential issue of shares. And lastly, watching out for Ramco Systems as well, because they will be providing their enterprise resource planning or ERP software to General Atomics Aeronautical Systems, and this is for maintenance, repair and overhaul of services. So some new business coming in for the company.
All right, thanks a lot for that, Sonal. The other stock which is also buzzing is Jmr Infra after the company signed a deal with Aboitiz Infra. Vahishta joins in. She's back with us. Vahishta, why is it that this stock is up almost 4% today, and it was buzzing yesterday as well?
Yes, that's right, Mangalam. Well, GMR Airports has signed a deal with Aboitiz Infra Capital, like you mentioned. This is for divestment of stake in Mactan Cebu Airport at Philippines. This deal is a part of their airports business, which is a part of their core assets. Now, from this deal, there should be 9.5 billion Philippine peso, which is equivalent to 13.3 billion rupees, in lieu of the shares being transferred and notes being issued. GMR Infra would also be entitled to additional deferred consideration, which will be earnouts for the next 4 years up to December 2026. Additionally, GMR Power and Urban Infra had divested 30% stake in PTGEMS. This announcement was a few days back, which is engaged in coal mining in Indonesia. Now, this is a part of their non-core business. There could be a possibility of GMR divesting more of their non-core assets. Let's see.
Okay, thanks a lot for that. Well, let's slip into a quick break. Prakash Gaba will be joining in with some trading strategies on the other side. Stay tuned.
Well, there's now a mild tinge of green on the screen. We started the show, all the frontline indices were absolutely flat, and now they're moving higher. And the key reason for that, for the Nifty to move higher, has been the way L&T has been moving. L&T has moved to the high point of trade, and ITC has been doing well. In fact, remember, this year ITC has been the best performing, among the best performing Nifty stocks. ITC has been up almost 50% this year, and this compares with the Nifty itself, which has rallied in just about double digits in this year itself. The best performing Nifty stock, of course, has been M&M, and Sonia will tell us why in just a bit. We have Prakash Gaba joining us. Prakash, an attempt to recover, but do you think it will be faced with some hurdle on the way up?
Well, good afternoon to you. Yes, Mangalam, looks like there should be a hurdle away. There's reason for it. On Tuesday, we saw a massive up move. What did we see yesterday? An inside day. A day within Tuesday. We are seeing today, again, an inside day of an inside day. So there's some kind of contraction building up here. So I feel this Nifty and Bank Nifty looks like there's a hurdle up there. Support on Nifty is at 7,500. That's crucial. And if that goes, Nifty goes. Will it happen today? I don't know. Will it happen on Monday? Possibly. But it looks like Monday could be a trending day, either up or down. So far, looks like we have run up too fast. We are holding it. And we need a fresh breath of air to take it up. If it doesn't happen, we are sliding.
Okay. So, we were just discussing individual stocks, right? There are plenty of auto stocks that have hit fresh highs today, Prakash, whether it's Escorts, M&M, Ashok Leyland. Anything that you're spotting where there could be incremental upsides?
Certainly, yes. I'll start with Escorts. Escorts certainly is looking good to me. I've seen a good 4 days of an up move and is still trending up. Trading at 2074, the next logical technical target should be around 2100. I think it's going there. Stop below 2050 on Escorts should be fine. There should be some money to be made on the long side on Escorts. Second play is, again, I would say Bharat Forge, an indirect play on auto, looking good to me. Bharat Forge, momentum is strong. I like the chart structure, higher time frame. I saw the correction. The correction is looking good. Up move is started in Bharat Forge on a higher time frame, on a medium term time frame. Even in intraday looks good to me. Trading at 764. Can it go to 780? Yes, it can go. Maybe take a day or two for that. Looks like Bharat Forge is heading there. Where do I have a stop? Maybe around 755. Bharat Forge as well.
Right, this week, Prakash, was also the week for a lot of these media stocks to be in focus. Yesterday Z was among the top losers, etc. But as we speak, Sun TV is the one which has now moved to the high point of trade. Do you think there's some momentum on this, or maybe it's just one of those flashes in the pan that we're seeing on this counter?
Sun TV was on my chart. Certainly is looking good. I like the momentum. It looks like the way it's trading is trading at 513 now. Possibly it can climb to 530 zone, Sun TV. Just have a stop somewhere below the level of 505 on Sun TV and trade long. It's looking good, certainly.
Okay, well, some news on Spicejet. Sources have told CNBC-TV18 that Spicejet will receive around 225 crores next week as part of the government's credit guarantee scheme. It will use this money to clear a lot of its statutory dues and lesser payments. Remember, recently the CFO Sanjeev Taneja has resigned as well, and a new CFO, we understand, will join as early as next week. Spicejet has been under a lot of pressure in the last 1 year, and especially after the numbers came out where there were steep losses that the company reported. The auditor as well said that the results have cast significant doubts about the company's ability to continue as a going concern. So now fundraising is definitely the need of the hour, and perhaps something is coming on board very soon. A quick word on this. Technically, it's been under pressure for a while, Spicejet, but at 45, how does the risk reward look for a trade?
Well, when I look at the chart structure of a high time frame on Spicejet, it doesn't look good to me. It looks like a hard landing out here and it's traded somewhere closer to 35. Can it survive here? Possibly it can. For that, it needs to cross a very crucial mark of 50. So unless it crosses 50, I'm not very bullish on Spice. It may continue to be sluggish. It could trade sideways. It could be sideways and bearish bias. But for me to buy, I need to see to it that it needs to cross 50. Unless it happens, I think it's weak, Spicejet. Possibly it may form a base here, but the confirmation is missing on Spicejet.
All right, Prakash, finally, before we let you go, any other stock picks that you've laid out for us today?
Yeah, I think I like United Breweries. That looks good to me. Yes, certainly. 1680 is a good, strong support zone to work with. Give some time and space. Possibly we'll see 1720 zones there.
All right, United Breweries is what you're looking at. I think it's just the stock and not the product.
But it's okay. I mean, he can look at the product.
He can look at the
as well,
product
right?
as well.
So
But yeah, most definitely. I mean, so what are you looking at, the product or the stock, or both?
Both, absolutely fine.
All right, Prakash, thanks a lot for joining in. Let's move on. Let's get in some market opinion. Earlier today, we caught up with Mahesh Patil, who is the CIO of Aditya Birla Sun Life. He hasn't seen much downgrade to earnings after the first quarter. He's also given us his sectoral outlook. Let's hear out what he has to say.
We haven't seen much downgrade to earnings after the first quarter numbers. I mean, earnings growth still remains around in the mid-teens for this fiscal year. And while there have been a few sectors like IT and some of these sectors where we have seen some amount of downgrades, but overall numbers have been fairly good. And the commentary has been, you've seen some improvement in terms of consumption, okay, which was seen a slowdown last fiscal year. So that is seeing signs of improvement over there. By and large, I think there was some kind of a pent-up demand. Okay, there were supply side issues which were hindering the auto sector, so those are getting addressed. The chip shortage issue is now getting resolved. So I think production levels are now coming back to normal levels. Demand is fairly decent, and I think overall, looking at the domestic economy, I think rural economy also is able to really do well in the second half, and that's what indications are. I think the demand for the rural side, especially for two-wheelers, should also pick up going forward. And the margin pressures, I think this would be the last quarter of that, and the correction in the material prices should help over there. So I think overall, I think passenger vehicles still looks, the demand looks good. One has to wait for the festive season. A lot of hopes are being bent on the festive season. So the IT sector, I think it started last 2 quarters because of the margin pressure in terms of the supply side. We've seen salary increases have been very large. But I think that pressure is now kind of peaking out because overall on the supply side, we are seeing that the pressure which was there in terms of salary increase, that is kind of now coming down. And availability of manpower is also now much easier. So I think the pressure because of that should kind of ease off. We don't see any further pressure or downgrade to margins going forward. And the key concern in IT sector as we move forward is going to be on the demand side, right? Because we've seen healthy kind of a mid-teens kind of a growth. Whether that will come down and come back to the peak COVID levels. In the short term, while there is slowdown in terms of on the global side, but I think we've seen a lot of disruptions. I mean, whether it's in Europe, we've seen gas, energy issues, which is hampering production. So actually, some of the manufacturing companies in India, we've seen actually benefiting out of that. They are able to, a lot of companies there are trying to source from other markets, okay, where disruptions are not ever supply steady. And especially on the engineering goods side, we've seen Indian companies trying to capture the opportunity and actually cater to that market. So in effect, actually, Indian companies are gaining market share, whereas overall growth is still kind of weak.
Okay, let's slip into a quick break. On the other side, we'll get you more on the markets and a lot of stock-specific action as well. Do stay tuned in.
General insurance companies, what they've sought from the regulator is a composite expense of management ratio.
The recommendation was there that why don't we have a single cap on the limit of expenses on management. So we have examined that report and accordingly a draft exposure has been put out.
Relaxing or removing the condition that private equity players can only invest through a special purpose vehicle or SPV.
Very soon we will finalize whatever we have to do as the private equity funds are concerned and the SPV, whether that is required or it's not required, can it be done away with. All of those are under deliberations.
IRDAI is considering giving a composite business license to existing as well as new insurance companies.
Composite license is not really an obstacle as far as insurance penetration is concerned. We need to amend the statute. So we are in discussion with the government. So at the appropriate time, the government will take a decision on this.
Welcome back to Halftime Report. Well, troubled airline company Spicejet is on our radar right now. Remember, the company has posted steep losses in the year gone by and in Q1 of FY23, and fundraising has been a big uncertainty for them. Sources have told CNBC-TV18 that Spicejet will receive 225 crores next week as part of the government credit guarantee scheme. Parikshit gives us more details. Parikshit, over to you.
Well, we saw how the losses for Spicejet have been mounting. They reached 789 crores in the June quarter. And now we're being told by sources in the company that they will receive 225 crores next week as part of the government credit guarantee scheme. And they will be using this to clear statutory dues and lesser payments as well. There was a lot of reporting about their CFO resigning, Sianjit Taneja resigning. And now we're told that the new CFO has been identified and will join from next week as well. At the same time, the company is actively working on its fundraising process. So this is the word coming in from Spicejet. But of course, there are a lot of things that the company has to work on in the days to come.
Okay, thanks a lot for that. Yes, definitely. Also, the CFO resigning hasn't been positive for them at all. But we understand, as Parikshit was saying, that the new CFO will come on board very soon. But Antique has initiated coverage on Patanjali. Mangalam, tell us about that.
Well, Patanjali Foods has been doing extremely well, the erstwhile Ruchi Soya, so to say. And the reason why Antique is bullish on the counter is the fact that, it's turning out to be a more diversified FMCG/FMHG company. FMHG would be fast-moving health goods. And this is on account of the diversification that they've done with, the acquisition of Patanjali's food business itself. It's the second largest branded player in the edible oil sector. The largest, of course, is Adani Wilmar with almost a 20% market share out there. The acquisition of Patanjali's food business, Antique believes, will only accelerate this diversification trend that the company is on. And they will not only benefit from the strong brand of Patanjali, but also their 5.5 million distribution network, 5.5 million stores distribution network. So all of that would mean that over the next couple of years, their revenues could actually grow by 22%, margins could improve by around 110 basis points, and almost a 49% jump in their profitability. So basis that, they valued the company at around 35 times FY24 earnings with a price target of 1725 from 12 months from now. So that's about Patanjali Foods. In fact, as we speak, it's up almost 5%. And sticking with the consumer theme itself, we spoke with Saugata Gupta, who's the Managing Director and CEO of Marico, for a demand check and discussed the company's FY23 outlook. And he mirrored the sentiment that everyone was saying, that, rural will take some time to recover, but gradually recover it will. And we have perhaps seen the back of inflation. Let's hear him out.
We expect, obviously, the volumes to be positive this quarter. Now, having said that, I think as far as profitability is concerned and the margins, we see that happening in the sector mostly in the second half, because in this quarter, although there has been a decrease in a lot of input costs, as you know, all of us hold stuff. We also pass on the benefit immediately to the consumer in certain ways, in certain channels. Therefore, that impact on margins in the sector will start happening definitely in the second half. That 18 to 19% margin over the full year, I think, is very much possible if the current trends are continue. We continue to see recovery in the discretionary part and the urban, and including male grooming, serums, or whether in some of the digital brands. I think the consumption story is very much intact. As far as rural is concerned, I think we are, we expect to see gradual recovery. Having said that, I think the worst is over a little bit.
Okay, so that's on Marico. Let's slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Do stay tuned in.
One look at all these hotel stocks and it looks like, maybe people are investing in hotel stocks as if they're running away somewhere, and they are indeed actually. EIH, for instance, is up almost 16% Royal Orchid is up 13%. Indian Hotels has hit a fresh high. We've seen a big move come by on something like Mahindra Holidays as well, up 6%. And beneath the surface, a lot of these smaller hotels as well, Kamath Hotels, for instance, Chalet, all of them up anywhere between 4 to 5 odd percent. And this at a time when all the other parts of the market are either flat or just about mildly in the green. So there is good news for the hotel industry. Everyone's pinning their hopes on big earnings coming for them as hotel rates are increasing and occupancies are moving higher as well.
Wanderlust, you know, as you say that.
And also a lot
everyone's traveling and then you're like sitting here in the
just
studio.
Just one look at the rates of hotels and you would want to drop your travel plans immediately because it's expensive. But that's good for the hotel industry as well because they had suffered through the worst times during the COVID itself. So it's good to know that, you know, people are traveling and traveling back with a fair amount of vengeance. Let's move on. Earlier today, we caught up with Rajat Bhattacharya, who's a senior investment strategist at Standard Chartered, and he says that the ROE is higher in India as against other emerging markets, and that explains why perhaps we're trading at a premium, a near 100% premium to all the other emerging markets in terms of valuations as well.
India has traditionally had high PE multiples. Why is that? Because one is, of course, growth, and you got the latest India growth data as recent as this week, and you saw where growth is in India, plus 10%, right? And whereas, for instance, China, they actually had a quarter-on-quarter contraction in second quarter. Looking forward also, China will recover, but India sits right up there in growth. The second feature that we've maintained about India is that the Indian corporates managed to capture that growth better than other emerging markets. And that is why you see the corporate earnings growth stronger than other emerging markets. The return on equity is higher in India than other emerging markets. Probably, you know, the Fed discusses a neutral rate. It's an esoteric concept, but what it means is that is policy restrictive enough? Now, the Fed believes the neutral rate is at 2.5%, which is where the Fed is right now. But every sense that came out of Jackson Hole from all central bankers is that probably the central bankers are underestimating the neutral rate. What that means is that they may have to raise rates further, and we will see the ECB coming through, right, next week with probably a 50 to 75 basis point rate hike. And that all that means is that even from 3 or 4 months ago, the central bankers now think that the neutral rate, the restrictive, at which policy turns restrictive, is a lot higher, which means we have way more to go.
Okay, so that's the word coming in from Standard Chartered on the global and the macro picture. But back home, the tractor segment is in focus. The tractor stocks have actually hit a fresh 52-week high. So both Escorts and M&M are sitting at fresh highs. And look at Escorts, it's now up over 3%. Now, let me try and tell you why. So in the numbers that came through in the month of August, tractor industry has finally seen a growth compared to a fall in the preceding months. So let's just take a look at M&M, for example. The tractor segment grew 1% this time, 1% on a year-on-year basis, but it compares to a fall of 14% in July and a fall of 13% in June. Even if you look at Escorts tractor sales have grown 7.3% compared to a fall of 18% in July and a fall of 19.8% in June. So from almost a 20% fall in June, it's now reached a 7.5% growth, and that's what the street likes. The management commentary was also positive. Both M&M and Escorts, M&M said that they're preparing for strong tractor demand in the festive season. They're optimistic that tractor purchases on auspicious days in the festive season will lead to a revival in demand. And they also said that the monsoon has been overall positive with 8% higher than long performance average. Escorts, the company has guided for a better September because of the same reasons that we highlighted earlier. So from a double-digit and a 20-25% fall, we have now come to a growth in the tractor segment, and that's what the street likes.
All right, that's what the street likes, and that explains why M&M is also the top Nifty gainer this year, up almost 58%. With that, we're out of time on this edition of Halftime Report. You stay tuned to CNBC-TV18 Business Lunch. We'll take all the action ahead.